everybody, and welcome to our panel. This is going to be mostly about cybersecurity investments. First of all, very briefly, the reason why cybersecurity should matter to all of us and not just a handful of people on our side of the panel here is it really affects every single thing you do in life. It's part of getting to work. If you want to get at work on time, your car needs to be able to drive there. If you want to transact online, your credit card needs to be able to work properly. If you want to book a flight somewhere, both the airplane and the flight systems, everything relies on security working well. And it's sort of the unsung hero. It's sort of when it works well, you never even notice it. So with that, why don't we go around the horn? I'll just do it alphabetically. Jared, why don't you start? Give a brief introduction and tell us how you got interested in investing in cybersecurity.
Thank you. That's good to be here. So I'm Jeremiah Grossman. I am. Am I echoing? Sorry, is that better? Excellent. Sorry about that, guys. So I'm Jeremiah Grossman. I am managing director of Grossman Ventures. I've been in cybersecurity for about 25 years now. I got my start at Yahoo a long time ago, where I was one of those kids that hacked Yahoo instead of calling the FBI. They gave me a job, and they put me in charge of hacking everything that Yahoo had. Took what I learned there, started my career, launched another cybersecurity company that grew really big and had one of the largest private hacker armies. And over time, I've been doing a lot of startups along the way, solving point solutions in security. And following the acquisition of my most recent company, decided it was time for me to evolve into a new challenge, which was investing in cybersecurity, investing in other founders that were solving the many problems we have in cybersecurity. So I'm pretty jazzed about that.
All right, thanks, Jared. How about you, Roger?
Great, thanks. Hello, everybody. Let's see, I came to cybersecurity a little different route. I'm a classic born in the Silicon Valley engineering product person, worked on semiconductors, operating systems, development tools. Apple Computer was where I did that. And then a good friend of mine, who's now one of my business partners, asked me a question, and he said, what is it that firewalls are made out of that they can be on the internet, but the rest of this stuff you guys build can't? And couldn't really come to a good satisfactory answer to that. I also was given a paper called Smashing the Stack for Fun and Profit. And these guys know that paper well. And frankly, that paper just pissed me off, and I wanted to do something about it. So I founded two different cybersecurity companies. One was called Fortify Software, that intended to help people write code better. The other one was called Alien Vault, which helped with the detection and response aspects of security. Most recently, I co-founded with four of the partners, and I'm a general partner for a dedicated cybersecurity fund called Ballistic Ventures. And very happy to be with you all here today.
Thank you so much, Roger. And how about you, Sid?
Hi, everyone. Sid here, partner at Foundation Capital. We're an early stage venture firm. We've been fortunate to be in business since 1995. We've been investing in cyber since 2001, so decent amount of time, both investing broadly in early stage venture, but also in cyber. I came into cyber very randomly, as many people in our business have. I kind of started my career in investment banking, worked in New York, and the way that at the firm I was at, which was kind of Lehman transitioning to Barclays, the way that things were structured on the West Coast, everyone did all the exciting companies and internet and consumer and all the fun stuff, and then on the East Coast, we used to do enterprise infra, and the most boring part of enterprise infra was cyber. And the reason it was boring was there was a view that there were only a set of players and they would own that whole space. And those players at the time were Symantec and McAfee and Trend Micro and Checkpoint. And there was this opinion that was it. And obviously that has been completely different. Today, we have over 20 public cyber companies. In fact, it's the largest number of public companies of any category in software. So I've been fortunate to kind of pop into the space since then, and subsequently I've gone into venture and been at Foundation for the last 7 years and investing for the last 12.
Well, thanks, Sid. I think that's actually a pretty good lead in. What do you think is different about IT investing versus cybersecurity investing? Like, why Why would you say one is different or better or harder or whatever than the other?
I don't think if it's definitely different. I don't know if it's harder, better, more successful. It's unclear. I think the reason for the difference, I mean, at least when I started, looking at the cyber category, and this is true for all three of you, I'm sure, cyber was considered part of IT. There was a view that, there's somebody in the security team and they reported into someone, and that person reported into someone, and then that person was the CIO. Cyber was not considered a core area, and today it is very much its own distinguished area. And in many cases, CISOs have now gotten the opportunity to go, reporting directly into the CFO or the COO, sometimes even the CEO, which is a unique position to be in. I think the big difference is that IT is a much, much larger category with a lot more larger incumbents, particularly the cloud infra vendors, the database vendors being two big subsegments. And cyber within that is still a smaller subcategory. Now it is growing at a much faster pace. IT broadly has actually seen generally flatline growth to kind of low single-digit % growth, where cyber has seen high single-digit to sometimes even double-digit in certain years % growth, which has been very exciting to kind of see. As a result of that, I think we've also seen kind of unique, dedicated cyber funds. Roger is obviously leading one of those fantastic funds, and that's a huge opportunity that we've created as a category.
Roger, do you have any thoughts?
Yeah, one of the things I would add, if you think about technology investing, we really benefit from major innovative change that's destructive to the previous set. Think about, one of the best ones to think about would be CRM solutions. There was once upon a time called a company called Siebold, and it was the company you use. When cloud computing became a thing, Salesforce.com emerged, and that new technology, that new way of doing things, allowed Salesforce to basically destroy Siebold's business and grow. Now AI is coming along. Good bet there may be some innovator out there that challenges the status quo. So these big shifts move things along. But during the period between the shift, the large companies take all the oxygen out of the room. So people will avoid CRM because Salesforce is out there and they're this big behemoth. One of the benefits that we have in cyber, we have actually two things that are disruptive innovation. One is the exact same technology, and the second one is adversarial innovation. So the neat thing about our market is that there is more regularly, opportunities for innovation that are responding to what an adversary does. And I can show this in an arc that just blows me away when you look at our market. And I'm going to use Checkpoint, Fortinet, Palo Alto Networks, and Zscaler. A couple of them might be offended, but those are basically firewalls. And they were done during, it wasn't one big, giant, monumental technology innovation that allowed them to happen. It was adversarial innovation that made each one of these important. Now, here's what's also amazing. So over this course of roughly 25, 30 years, you have these big companies. Checkpoint's still a multi-billion-dollar market cap company. Fortinet is still a multi-billion, and tens of billions, both of them, market cap companies. Zscaler, Palo Alto Network, the most valuable cybersecurity company there is. So our industry has a lot more opportunity to find compelling investments because of the changes to the environment that the adversary brings. I don't want to be 100% positive, so let me give you the negative. The fundamental negative about our industry is nobody on earth wants to do cybersecurity. Maybe the bad guys, I'm not sure. But people are doing it because they have to. And so it makes vetting cyber deals a little bit tricky. It's not everything that you see that sounds good that will be successful. It's everything you see that somebody ultimately will be forced to use. You could be forced by an adversary of a hacker or a nation state, or you could be forced by a regulatory body. but ours is a little tricky that way, but an enormous opportunity because of the nature, the adversarial nature of the market.
So Jeremiah, we are about to, according to McKinsey anyway, see over the next 10 years a 10x increase in the size of the market to $1 trillion, maybe as much as $2 trillion annually. And that's on the positive side. On the negative side, you have guys like Ross Holleyluke, who are predicting that it's only going to be about a 10% increase year over year, sort of kind of following what Sid was saying, where it goes up just kind of incrementally, single, maybe barely double digits, following the trend line of IT. So, in your opinion, which do you think it's going to be? This massive increase? It's going to start flatlining? Where are we going?
It's a really good question. So our industry grows by 10 to 12%. Cybersecurity grows by 10 to 12% every year. It never really goes faster. It never really goes slower. I mean, this has been around at least the last decade, maybe 20 years. So it's hard to imagine that it's going to go down, or the rate of climb is going to go down anytime soon, because it kind of relates with what Roger was saying. I think Roger nailed it. It's to invest well in cybersecurity, you have to know everything that technology is doing or trying. Then you have to time what technology is being adopted, whether you're talking cloud, software as a service, or blockchain, and now AI. And you have to time what the adversaries are going to do and what startup innovation you need. That's what makes it hard. But at the same time, I think Ross, and we love him to death, but it might be he's too logical, too analytical. Yes, it should make sense that maybe it would decline, but nothing in cybersecurity makes objective sense in that way, because you have this little thing called the adversary, and whatever the adversary does, whatever damage they're going to do, we rush to spend on it. So will it keep climbing? I think so. Are we going to be spending in the right areas, or are we going to see shifts around? More than likely.
How about you, Sid? What's your prediction?
You know, it's funny. In January of 2019, I wrote a blog post right before RSA conference that year to actually highlight this point. I said, "Is cyber the next $1 trillion market?" And back then, in 19, I kind of made the argument that in 10 years it would be a $1 trillion market. I think that as of now, unless Jeremiah's right and it's going to grow at an astronomical rate, I'll be wrong there. But the reason I made that argument on this point was, if we look at the world, I mean, the world is moving more to the digital realm. You know, at the time, about 30% of the total population was on social media. I think probably it's more like 50% today. I haven't looked at the latest data, but it's probably in that region. Most folks are accessing their financial accounts, their personal information online, rather than going physically to a bank to go and pull their money or store their valuables. If you connect that with the fact that at the time, just for context, in I think 2017, 2018, the total amount of money spent on physical armies was just under $2 trillion. The fact that the world is moving to this kind of digital world where our valuable assets, whether that's money, our personal information, or logins, or the way that we access the world, if those used to be in the physical world, we used to have a physical key to open our house. Now maybe you are using a digital key instead of a physical key. You have to protect the digital world just as if you are protecting the physical world. And if we assume that physical armies is somewhere in the $2 trillion range, there is an opportunity to go and build at least $1 trillion market in cyber. So that's how I came up with that number. And Robert, I still believe that is true. I've been wrong. I think I will be wrong on the timing. Maybe there'll be something that'll happen in the next 3-4 years that'll completely change it, and I'll be right. But I do believe that the numbers that McKinsey has are the right way to think about it. But hey, I'm a VC and I'm an optimist.
If I could add on something,
I'm rooting for you, Sid. Go for it, Roger.
Sid said something that was really profound. The notion of warfare is digitizing just like every business in the world. And I mean, my gosh, it was back in fortifying, I don't know, 2005 maybe, that a very senior Air Force general had explained to me, you've got the domain of space, sea, land, and the air, hence the various military services, and then cyber. And he had said at that time, and I do not believe it's reduced, the amount of literal warfare going on in the cyber domain between all the major characters, if it were going on in the land and the air and the sea, it would be on the scale of World War II. And so we are fighting wars with each other, whether it's wise or not. It is a thing. And one of the problems is that in the cyber digital battlefield, these nation state wars spill over to companies. And now companies have to defend themselves in this insane battlefield where large, very sophisticated armies are fighting each other. And I don't know if that argues for our market getting larger, but it certainly argues for how critically important it is to get this right.
Yeah. One thought I just had with based on something Sid said. So if the thought is we're going from 200 billion to $1 trillion in over 10 years, and we also, as Sid mentioned, that cybersecurity is a small percentage of overall IT or the overall software market. If we go to $1 trillion, where do they go? If we're going to keep the same ratios, I don't think we're going to have an increasing ratio on software, the software market. So we're just going to have a lot more software in the world, a lot more.
Okay, so let's talk about spending. This is the World Economic Forum, so I think this is a good time to bring it up. This morning I checked out the price of gold. It's 2,733, and a year ago it was 2,026 rather. So that's an increase of $706 an ounce. If there's 212,000 tons of gold mined, that's 6.8 billion ounces, which means there's $4.8 trillion locked up in gold that wasn't locked up 1 year ago. At the same time, we aren't seeing hardly any IPOs in the InfoSec space. So how is that affecting liquidity in the market and your ability to raise funds and place funds and get your money back, et cetera? Go for it, Roger.
Okay, so a few things to break down there, Robert. One of the aspects of capital market and gold and all this stuff is, when interest rates around the world were at zero, a bunch of money that wanted to be in bonds and money markets and boring places were forced into capital markets in one way, shape, or form. Now trillions have moved back to where they wanted to be in the first place, so fixed income and what have you. One of the things that we noticed, we were fundraising during that transition, there seemed to be to us a playbook in the allocators that invest in venture to barbell things a little bit. And that is, as I'm able to move more into fixed income, I would like more exposure to super high alpha, potential high return investments. So I believe from not necessarily a study, but from firsthand discussion with 100 or so large capital investors that was going on, that helped the venture industry raise money. The returns on venture, and this I do know well, because even while I was an operator, I worked around venture firms, and I have many friends who've been in the business. Several of my investors constantly sharing information with me. A very small percentage of the venture capital industry returns handsome returns. Sid works for one of those firms, Foundation. Some of these long, illustrious firms in technology do quite well. But the fact is, the top quarter provide almost all of the returns, the bottom 3 quarters don't. And so with all things venture, it's high quality. You've got to be in the highest quality companies. Now, why is that? Because in our world, we and Ballistic is on its second fund, so I can't really recite our statistics. These are industry statistics. It is very common for a venture fund to have about 1/3 that didn't work out, about 1/3 with a return, and about 1/3 with a fantastic return. And that is in spite of a good venture firm may talk to 100-200 companies for every single investment they make. And they agonize these investments to death. And they look at them every way from Sunday. And so every single one of them they thought was going to pan out. And you're talking the best of the best will get the right a third of the time. But the fact is, within that you get it right to the third of the time, you have 10x returns, 100x returns, thousands x returns. So the whole business is not based on moving a whole bunch of companies through to public markets. We just need a couple. And what'll happen is around the periphery, lots of other things get eaten up, bought up. It'd be interesting to see what you guys saw, but Jan 1, what was Jan 3rd or so, we come back to work. 3 of our companies have deals working, not necessarily that they're going to take them or what have you, but there's a lot of activity in these markets that don't result in an IPO that are pretty darn good returns, but that 1 or 2 that are breakaway IPOs make the entire market.
Okay, how about you, Sid? Anything about the liquidity you want to
I
talk
think
about?
Roger put it really well. I mean, we are in I think probably the 2 things I'd add, Robert, you mentioned that InfoSec has had a tough time in getting enough IPOs. I'd actually argue that's true for all technology companies. I don't think that's specific to InfoSec. In fact, there are 5 companies that went public last year, and one of them was an InfoSec company. And you could argue whether Rubrik was InfoSec or IT, but it was somewhere it was very much in part in our category. So the fact that we had a fifth of the total IPOs that happened in 2024 is actually a positive sign, not a negative. But I do think, despite all this, liquidity is a certain key hurdle. In fact, just this weekend I was looking at the latest PitchBook NVCA monitor. So they push out these quarterly updates on data that's been kind of researched. And one of the facts that was most interesting to me was there are about 1,300 VC-backed companies that are valued at over $500 million, and just 40 of them had exits last year. And just for context, to be able to fully kind of empty that portfolio of 1,300, if we stayed at the steady state of 40, it would take us 30 more years to see that happen. And that's assuming that there was no one else got a valuation higher than that of $500 million. There are about 800 unicorns, representing about almost 2 trillion of total value. So we are in this very difficult position where there's a lot of private capital that's kind of stuck. And until we see some level of release, whether that be through M&A, as Roger described, or the some sub segment of IPOs, we are going to be in a tough time. And I think our investors, the limited partners who invest in funds and venture capital, they want us to see more results, and they want us to go and return capital, because at the end of the day, they use that capital and they recycle it to invest back in our funds.
As I was looking at the $4.8 trillion in gold lockup, that was the beginning of the question. It's hard not to be affected if you're an investor in the space or venture capital in the space, not be affected by the larger macro, the financial market macro. It's hard not to be affected by that. But if you look historically over venture and InfoSec, I think it's somewhere between 10 and $20 billion goes into venture every single year. So 4.8 trillion versus 10 to 20 billion per year. And if you believe that we're going to increase the size of this industry by 5x, there's a large opportunity for some winners, in that market. The dollars in, dollars out is massive, but that strikes right to Roger's point. It's hard to get it right, and most will not get it right. So who is in the best position to find those key investments that will pay for the entire market? That's what's key here.
Okay, well, I guess this asks the right question of sort of being a VC, you have to pick the right ponies. So there's a lot going on when we're talking about doing technical due diligence. We're talking about the people, the strategy. There's a lot of competitive pressures. So how do you guys go about doing due diligence? Jerry, you want to start that one?
How do you go about doing due diligence? Okay. first and foremost, I think the market always wins. No matter what you do, no matter how smart the team, how great the tech, the market always wins. You cannot beat the market. So how do you understand the market? First, it's helpful if you're a cybersecurity expert, you've been in the space a long, long time, because that makes you intimately familiar with the actual problems that are in there, and not just the headline news. So you have to make sure the investment is tackling the right problem at the right time. Second, you need a really, really smart team, and they don't have to be right about all their assumptions. But what I'm looking for is people that organically found the problem, they lived it, they experienced it, and they have an emotional attachment to solving it, and that they're humble enough to spot their mistakes in execution and are able to fix it and overcome them. Because inevitably, for an early stage company, they'll probably get all their assumptions wrong at one point or another. So they have to be able to overcome those. Then the third one is the actual solution. Does the solution solve a real problem that's really important? And is the team smart and experienced and humble enough to get over those early stage challenges? If I see that ingredient mix and the price is right, that's a solid investment.
Roger?
Very similar to what Jeremiah said. There's when you're investing in the early stage, there's not a lot of contracts to look at. There's not a lot of product to look at. The product's probably going to be replaced. So what you're really dealing with is more first principles. And if I were to, share what I think are the most important ones to people that might want to be investing in the space or what have you, I just can't stress enough how important the stock of the founders are, their grit, what they're made of. And there's rarely a single person that embodies everything you're looking for. So you generally find it in twos. I had the good fortune to work for this company called Apple Computer, and the founders were legendary heroes.
What do they do?
I kind of use them as the quintessential hacker in a good term, and Steve Wozniak, just somebody that can build anything. And then the hustler in the form of Steve Jobs, who I think was misunderstood. And in my assessment, he wasn't an artist or an engineer. He was a merciless doer and driver of things. So if you see in the founding team, or I guess I would say, if you don't see those attributes in the founding team, keep your checkbook closed. Now, the question is, how much of that do you need? Probably more than you could ever find. So it's a matter of optimization, not perfection. And then the other one, and I'm just going to leave it at these two. There are a lot of companies that you run into where somebody says, I invented this thing, it's a beautiful thing, and now the world's going to see how great it is, and I'll make a fortune. Not saying that once in a long while that doesn't work out, but there's a different kind of founder that says, there's a problem, I maybe experienced it personally, or I've studied it, I understand it, and I'm going to solve this problem. And if you've got the hacker and the hustler, and they're locked onto a problem, and now as a venture capital firm, we very easily can go validate how real that problem is with our network of people. If you've got those two things, and then the last part is how many other people are trying to solve the problem, what advantage do you have in solving the problem with the others? And if that all vets out for an early stage venture capital firm, that's about as good as it gets. We don't have a lot of any would-be entrepreneurs out there. Start with customers, and I always tell people, customers will talk to you when you're an entrepreneur. You're fun to talk to. You're not threatening. The minute you have something, you have salespeople, they don't want to talk to you. So take advantage. Just get people who are serious, who have the problem, to be on board with you, and so you throw that in there too, and now you have a pretty nice looking deal.
What do you think, Sid?
I think there in investing, there are kind of 5 things that matter that most VCs are looking at. In some cases, some of those things don't exist. Sometimes they do. And the 5 things are really, founder, and who are the people you're backing, market, What's the size of the market? And Jared talked a little bit about that. Product, what are they actually building? How does it compare to what's already in the market? Metrics, which is assuming they have some customers, what do they have? How are they doing? How are they growing? And then valuation, which is for the VC, what am I coming in at? How much am I going to own? How much am I investing? What's the valuation? For us at Foundation, 80% of the time when we invest, we're investing pre-product. So we're coming in super duper early. So product doesn't exist in that scenario. Certainly metrics don't exist. The other three factors matter. And this is where I slightly disagree with Jared. The stage that at least we operate in, market is important, but candidly, founder is the most important. And Roger described grit. I kind of say relentlessness, which is just, are these founders able to keep pushing forward even as they have to adapt? And at the stage that we're investing, typically, that insertion point that you think of, that may change. It may change multiple times. But are those founders going to be able to kind of move as the market moves, or as they realize, hey, this isn't the right insertion point. Maybe we need to think about X or Y or Z. That for us matters deeply. And probably the best example of this is CrowdStrike. And George and Dimitri are going to hate me for saying this, but CrowdStrike really started as a services business. I mean, it's called CrowdStrike Services. You can look it up in the data. It was a services business. And then they went and discovered Falcon, which was, a unique product that was created as a result of a breach that Google was dealing with. Roger described kind of how breaches impact growth. And that was a great example of how a breach impacted the opportunity for a company. And they released this new endpoint agent, which has completely transformed not just that company, not just CrowdStrike, but the entire industry. And I think that's probably the one company that almost everybody, whether you're in cyber or not, has heard of, just given the events of last summer.
I agreed. Okay, so you guys kind of all talked about the founder. I'm kind of curious, what if the founder shows up, great product, great idea, right timing, everything's good, but they have zero actual real world experience. They've never done it. They don't know anybody to sell to. They couldn't find a customer, if you gave them their phone number, you know what I mean? Like they're just because this does happen. We see a lot of outsiders come from IT, or they come from some sort of business organization, or they come from academia, and they show up and they're like, hey, I've got this idea. Are you going to take that bet?
I think for myself, I was at one point in my career, I was that bet. So it's hard for me to say otherwise. And it comes down to that, what I said earlier, emotional attachment, what these guys called grit. I think it's fine if they're first-time founders, if the problem is real, they have that grit, they're going to grind and be relentless. Nothing will stop them. Customers, CISOs, heads of security will talk to them, but it won't be easy. It will be a grind. Every email, every LinkedIn connection, every conference you go to, it's just trying to build up that network, and you can get through all that stuff. So if all other things being equal, yeah, it doesn't bother me that they're first timers. What I'm looking for is that perseverance.
Roger?
Yeah, I would tease apart two separate things. There are lots of great founders in cyber, Jeremiah, for example, that didn't have some formal background in creating a company or what have you. There are even ones that weren't even in cybersecurity prior. I was not in cybersecurity before I created Fortify. But they still got to have that kind of founder ethos, if you will. There are cases though where a professor somewhere really is the person to start the company, but they're just not the right founder. And we've got a company in our portfolio called Get Real Labs. It helps with deep fake detection. The absolute #1 expert in the world is a gentleman named Hani Farid at UC Berkeley. And we recruited Hani, told him, hey, you don't realize this yet, but you're the founder of an awesome company. And then we constructed a founding team with him and a few other people that made it perfect. So you can find ways to bring that person in who's got maybe, in this case, just unbelievable depth of domain expertise and construct a company. You can only do it if you incubate or if you're the founder that wants to do it that way. Once it's kind of moving along, it's very hard to interject something like that.
Sid, what do you think? You going to take that bet?
I would. And I think like all of you, I've certainly backed enough technical founders and been excited about finding those folks and helping them to grow. And I think the most important thing, Jared described this, and even Roger highlighted it with the example that he used. But you're looking for people who have this curiosity, and that curiosity is really around kind of saying, hey, I can improve myself, regardless of where they are in their life journey. You may be the most successful professor in a subcategory, but if you're not willing to learn new things, that makes it really hard for you to become a successful person to speak in front of CISOs. So as long as you're able to adapt, learn, grow, that's a big factor of being a great founder. It's less about what are your skills already, but what are the skills you can acquire over time. And the vast majority of first-time founders have never been CEOs. So the likelihood that they know exactly what to do is almost 0%. And I think all of you will agree with me, no company is the same. So it's not like we have a playbook for them that we can kind of give to them and say, hey, do this, do these 12 things, and then you'll have a successful cybersecurity, a broadly successful software company. There's almost an infinite number of ways to fail. And I think you learn that as you spend more and more time in this business.
Yeah.
And maybe it's kind of half the fun is to help them out, right? I mean, if your actual value add, because there's a lot of VCs that aren't value add, they're just a check. Actually, I think this is a nice dovetail here. So we're seeing kind of a wave, and I'm sure the wave has existed for a while, but I'm more intimately familiar with it because I'm seeing it personally. Of a lot of companies that are getting funded and they don't even have an idea yet. There may be just a person. Maybe they kind of have a half idea and a PowerPoint deck that kind of points in a direction, but not a real, actual viable business. And worse yet, these valuations are sky high for the non-idea. So how do you see that input shaping the output? Are these companies actually going to be viable? How do you think about how it changes the market, et cetera? Who wants to take that one?
I'll take that one first, because I have seen my fair share of these. And those are the ones that are going to be the bottom 2/3 of the market, just like, Roger pointed out. That's what's going on there.
What do you think, Roger?
Well, ours is a market just like any market, right? And there's only so many of us, and there's only so many companies. And if you're the company that gets everyone interested, you're going to have a high valuation. There are really good reasons to have a high valuation. And so let's just kind of tick off a couple of them. One of the greatest indicators of future success of a startup is previous successful startups by that team. And you get to a team that's done 2 and it's their 3rd. It just doesn't set up better than that, right? We worry sometimes about the second one, that now they got some money, they still have the same motivation, are they still humble? But you get to the 3rd one and you've even gone past that. There is the proximity that team has. How well does the market know that team? So if that team, it's their 3rd startup and they're well known by everybody to be super experts, they know all the customers. And then lastly, how much of their own capital did they put into it? As an investor, if I put $1 in for every $1 you put in, well, I go twice as far. And so some of the very highly valued startups fall into that category, and they frankly should. The problem arises when you get a buzz around a company, and it's generally a very sharp young person who's inexperienced, hasn't done it before, but worked somewhere, has a lot of very famous, wealthy people, maybe supporting them, and a little bit of early traction. Those could end up pricing through the roof. Some of the deals that come in from overseas are packaged up so well and look so great. And so buyer beware, but some deals are expensive for very good reasons. I would argue emphatically, these are all the reasons to be an early stage investor, because there's only so ridiculous you can price something without customer traction. Where you see the crazy numbers are in B and C rounds, where the company's really getting some fast uptake. And at those prices, it just has to continue. If it doesn't, you're sunk. But that's a different story.
All right, Sid.
Yeah, I think The only thing I'd add to some great thoughts from Roger and Jer is really that, look, a high valuation is not always advantageous, even to the founders. At the end of the day, this is paper money that we're talking about. In our business, we say you can't eat TVPI, which basically is the value of these companies and our funds. It's the same thing, as a founder, you cannot eat your equity. There is no way for you to sell that equity. It's illiquid. And when you put up, and usually these valuations are kind of future success. So they're the value of your company typically 2, sometimes even 3 years from now. If you don't realistically believe you can hit those milestones, it does not seem like a good idea for you to go and raise at these crazy valuations. And typically what you'll find, and Roger described these multi-time founders, some of these multi-time founders will actively go and say, look, I don't want that crazy valuation. I'd much rather prefer a more reasonable valuation, because they are already thinking 2, 3 steps ahead. They're thinking about, well, what about the growth round, as Roger described? Can we keep that pace? Oh, do we really need this level of capital? Is this the amount of money that we need to grow sustainably? Some of them have taken their companies public, so they will be thinking well in advance, which is, do I have some path to profitability? Because if I don't have that path, I can't go public. There is no option for me to go public. Going back to your first question, Robert, that's part of the reason why we haven't seen enough IPOs. Many of these companies may have hundreds of millions of ARR, but they don't really have a path to profitability. So they cannot go public in the public markets, because the institutional investors and the later stage investors, they don't want to go and own those assets.
And that starts the down round and the death spiral, and eventually they're going to have to sell for pennies on the dollar, et cetera, et cetera. It's a nightmare.
When Sid, you guys mentioned 2 things that just hit close to home for me. It's the teams that have done multiple exits, myself being one of them, and then also when you're in a situation where the deals, the term sheets are competitive, and to compete, the VC will say, we'll give you a higher valuation. I was in that position where no, I don't want the higher valuation, because it'll break the company. We want to keep it lower, which is to say sensible, because the whole point is to eat the high valuation at some point in time. And if the valuations get sky high, you'd have to do unnatural acts, and it just scuttles the company. We've all seen it endless amount of times, and we just want to avoid it.
Yeah. Okay. So switching gears a little bit, the government has an agency called CFIUS that attempts to limit foreign investments in security companies, specifically ones that will either deal with governments or government contractors where they'll inherit this technology and will be used inside the government. But more or less, it kind of looks like it altogether halts the ability to do that work with those companies or the government, and often involves investigations. It's kind of a nightmare, both for the companies that port codes, but I'm imagining for you guys as well. So how do you guys kind of model that, sort of the nation state, sort of, I don't know, the weird extra question mark at the end of whether this investment makes sense with regard to any government intervention?
I think in our case, at least, the primary amount of investing we do is here in the United States, and we're based in the Bay Area. We have 2 offices here, one in Palo Alto, the other in San Francisco. And so most of our companies, they're not under the purview of CFIUS. The complexity actually comes in when they are looking to have customers who are outside of the United States. And there's a big question mark on, can they acquire those customers? And we're seeing some of this conversation happening, particularly in terms of how GPU chips are kind of sold. Should they be sold to certain countries or not? And I think the new administration is going to make that decision. Look, I think, Robert, CFIUS is the right committee to have. There is a fair question to be asked around, should US dollars or US consumers be interacting with certain threat actors in some way? If somebody is being funded by a government that we don't approve or we don't look to partner with, then that is something that we should all be thinking about. Does it add additional bureaucracy? 100%. But is the end goal the right one? It absolutely, in my mind, is. And certainly we could do things to make it more streamlined and more effective. But I think the approach is the right one.
Roger?
Well, so a couple of perspectives I could knock out real quickly here. Part of CFIUS is making sure that bad money doesn't end up in companies and what have you. And think about being an early stage venture investor where there's going to be potential for bad returns, potential for great returns, a lot of variability. You want to make sure all of your investors are institutional, professional, completely understand what they're doing. Anybody out there that is investing in venture funds, make sure whatever you're going to invest, you do it over a number of funds so you get the time element factored in to your investment. And the last thing you want is some criminal organization that's going to come murder you if you lose money. And so there's not just a regulatory reason to do that. There's personal safety. You want to do that. The way most venture funds do that is there's a very small set of institutional investors that would qualify to invest in a U.S. venture fund. And so for anybody outside the country that wants to invest in venture funds, you're probably better off to contact some of the the large institutional aggregators that have the wherewithal to vet you really well. And so the other point Sid made, most U.S. investors are going to invest in U.S. companies, and there's basically a rationale. If a deal falls on my desk, let's say it's in healthcare from Germany, I think to myself, wow, how lucky am I? All the German investors didn't get a look at that. None of the healthcare people, between me and them, it just landed on my desk. No, the truth is they all said no. And so the farther you are away from the deal, you're probably not going to see really high quality. And then the last part, I'll leave it as a teaser. Cybersecurity has balkanized the internet already. So the rules of how you operate on the internet in Europe are very different from the rules with which you operate in the internet in the United States. And then for all practical purposes, China is just not an open market for US cybersecurity firms. And so the complexity of dealing with international markets itself creates cybersecurity opportunities, right? Because you need to be able to operate your bank or operate your manufacturing company legally in all these different jurisdictions. And so that's a whole ball of wax itself. But CFIUS is a great thing, and you want to be very, very careful who are your investors.
Okay, well, I think we're kind of getting close to time here. So kind of a last question, I think, for the general audience here would be kind of interesting. What do you think is interesting in the market right now? Like, what areas do you think are hot? Which areas would you stay away from? Jared, you want to start this one?
Oh, that's a good question. I think these days there's always room. There's, I guess, two styles of companies. There's the startup that goes after a new point solution in a new market that's unbudgeted for the buyer. So can you find a new narrow niche and convince companies to spend money solving a problem that they never spent money on before? And I've done those companies. And then there's the other ones where you make a new, better, faster, cheaper product and go into an established market to disrupt the other mainstay players. And I think Sid was the one that mentioned before, there used to be Symantec and McAfee, and they were replaced. And there's going to be opportunities as technology changes, as innovation changes, as the adversary does their thing. There's going to be constant room for disruption in both areas of the market. But for me right now, I'm looking at broadly across the market at, let's say, the big publicly traded companies, the big, unsexy, well-established markets. I think those are all unsafe for the bigger players. They're all open to be disrupted right now. They are not innovating. And we said it earlier, $200 billion goes into our industry every single year for everybody to be hacked all the time anyway. Nothing's really working. For all the founders out there, the opportunity is there to do it better. And all the investors will be rooting for you. We want to meet you.
Great. Sid, how about you?
I think we are seeing a fundamental transformation, particularly in terms of how do we leverage AI agents to go and automate some of the workflow that humans are working on. And we have a big demand supply imbalance in the workforce in cyber, and that we just don't have enough people who have talent for the roles that CISOs and the security teams want. So we have to go and fill that gap. And the only way to fill it is with software. And AI agents provide us an opportunity to kind of have virtual agents fill some of those tasks, not the entire role, but some of the tasks, so that you can almost multiply the human talent that you have. In terms of where to apply that, I think email security is one area that has been very nascent. Jer talked about categories that haven't seen a lot of innovation. Email, I think, has seen very little innovation. Roger highlighted one of his companies focused on deepfake. I think that there's a huge opportunity broadly in phishing and how you solve these issues, which are only going to get more complex as a result of AI as threat actors use that. I think the second big area, the broad category of product security, application security fits into that. Roger's built a company in that space. I mean, all of the incumbents there are over 10 years old. Like they've been around for a while. So there's an opportunity to go and build something new that is really taking pieces of the workflow that humans are responsible for within product security teams. And then the third area I'd say is, I think in network, we've seen multiple iterations of network security. Again, Roger highlighted 4 of those companies. Palo and Zscaler very much are the kind of the leaders today. I think we're going to see a next generation of network security. And the reason I believe that is, first, we are starting to see a lot more people work from home and log in from home. The fact that the 4 of us are here doing a virtual panel is an example of that. We're not at Davos in Europe. I think the second factor is that we are seeing a complete transformation in how we access the internet, partly because of 5G and the rollout of 5G, which is a complete new way to think about cellular access. We will now have gigabit speeds on cellular access rather than using the fiber. And then we're not even factoring in the fact that we're using satellite internets at scale. Starlink is very much working at scale. So the way that we access these different applications is going to change dramatically. In the past, you used to go into an office, you are protected by quote unquote a firewall, which is a physical device inside of your office. You can't do that in every person's home. And you certainly can't do that if they start using cellular technology and satellite technology on top of fiber. So just thinking about what is the future of network, that is something that I think we'll see a new opportunity.
Great. Roger, last words.
All right. Agree with all the aforementioned points. What Sid talks about always reminds me, the edge of the network that we need to protect is the people. It's become the point where so very people-centric security, I think, look for things in that space. The idea I wanted to leave, though, hey, we're talking about cyber and it's, what's hot and new. Everyone heard this thing called AI. A good way to chop AI apart in cyber is, am I going to use artificial intelligence to improve upon one of the myriad of cybersecurity tools and techniques we use and disrupt and entrenched player? Am I going to protect the AI that's being built by somebody, or am I going to be protecting myself from an adversary using AI? And then we actually add a fourth, which is, I'm going to use AI, help me do it safely. So when you think about AI, there's some good swim lanes. And the other one to remember about AI, and that's this: the advantage in AI goes to the person who has the proprietary, interesting data that can train things. This is one of those rare moments in time where some of the established incumbents are going to have an edge because they have enormous troves of data. So if you're a startup company and you're going to use AI to disrupt an incumbent, well, you got to figure out how you're going to make up for that data disadvantage. And a lot of companies, that's hard to do. And so we end with AI.
Great. Thank you, Roger. All right. So Jeremiah, how do people get in touch with you?
Oh, let's see here. I am on X at Jeremiah G and LinkedIn, and just probably the 2 fastest, easiest ways to get to me.
Roger?
LinkedIn and Roger at ballisticventures.com.
And Sid?
LinkedIn's the easiest. Just type in Citravedi and you'll find me.
Gentlemen, I really appreciate your time. Thank you to the audience and to World Economic Forum, and we really appreciate it. Thank you, everybody.